with how much debt there already is on a national level and on a global level, even when the economy rebounds, like once you go down this road of a real decrease in purchasing power for the middle class, even if people start getting jobs back and things like that, and we see kind of a growth in a big growth in jobs again, and we can get back down. I don't think it's possible to get down below 5 anytime soon percent unemployment, but I mean, if they can keep it below 10, you know, and people have jobs again, but the inflation goes up a lot. But it's not like hype. There's the people that are like hyperinflation and the dollar will
Yeah.
be gone tomorrow. You don't seem like you're in that crowd at all. At least like kind of judging by what I've my research before and then talking to you today. But let's say that we have inflation and it's intense, but it's nothing that we haven't seen before. Let's say it's just like 10% year over year for a couple of years, which is a lot, but not, not carry wheelbarrows full of dollars around to go buy a sack of beer type of thing. How do you ever go back from that if the national debt is already so great anyways? Like, is there a point where you believe there has to be a currency reset or a new monetary system, or how do you see that type of conversation?
Sure, there could be. If you look back, so we've had in the past century, we've had two really inflationary decades, and those were the 1940s and the 1970s. In the 1940s, a lot of it was because of the war and because of the massive monetized deficits to fund the war. But because federal debt was very high, they didn't let interest rates rise. So normally, in order to quell inflation, you raise interest rates. But they couldn't let that happen because the sovereign would default. So instead, what they did was they locked yields below inflation, and they just kind of said, you know, if you have cash and treasuries, shame on you. You're just going to lose about a third of the purchasing power. So over a decade, that's what happened. But then, because they kind of came together after that, and they some of the debt was inflated away, but they had a really strong productive base to build from, and society was kind of all unified. They kind of came back and they built up, and we had kind of an economic boom. The 70s were a little bit different because at that point, debt was actually pretty low. So that was after a long period of deleveraging in real terms, and federal debt was very low. And so when you had that a more inflationary outcome, the central bank could choose between raising interest rates, which would quell inflation, but it would probably lead to higher unemployment, and kind of it would make it harder to borrow money. On the other hand, they could keep interest rates low, but then you have uncontrolled inflation. And for several years, they were kind of bouncing back and forth between to figure out how to deal with that. And eventually, you got Paul Volcker in the early '80s that firmly chose, okay, we're going to do whatever it takes to stop inflation. So he jacked up interest rates, and that killed inflation. And then going from there, we've been in a 40-year disinflationary cycle. So going forward, in many ways, it looks more like the 1940s in the sense that because debt's so high, they don't really have an option to let interest rates rise. So they're likely going to do yield curve control if we ever get a more inflationary kind of rebound. And what makes this period challenging is if you look back in the previous long-term debt cycle, the 1930s had very high private debt as a percentage of GDP and very low federal debt. And
Oh,
then so yeah, and then so they devalued that by devaluing the dollar versus gold, because back then it was on a gold peg. So they did all that. They printed money. Then you had the 1940s where you had this big federal debt buildup, but by then private debt was very low. And then of course like I said, they paid off a lot of that federal debt by inflating part of it away. So it was kind of like two separate periods that they dealt with it. First, they dealt with the private debt bubble, and then they dealt with the federal debt bubble. Now, if you look back to 2008, we had another private debt bubble. So we were kind of going along the same route. And then in response to that crisis, we increased our federal debt by a lot. So we went from, going into that crisis in 2007, we probably had 65% federal debt to GDP. And by the time that crisis ended, we were just over 100% federal debt to GDP. So we kind of increased debt a lot. However, we only partially deleveraged the private debt system. So household debt deleveraged a little bit, and is still kind of below those 2008 levels. However, business debt did not deleverage, or at least not permanently. They did small deleveraging, and then they built it right back up. So we still are at kind of an apex of the long-term debt cycle, and this time it's both federal debt and private debt. So that kind of makes it really challenging, kind of to deal with. And so we have strong deflationary trends from technology growth, from aging demographics, and from just all this debt overhang. But on the other hand, when you have that kind of more aggressive deficit spending and monetary response, you get a more inflationary cycle, and it's really challenging because they wouldn't really be able to raise rates, at least not for a while.
Yeah, basically we have the worst of every one of those historic trends all combined into right now. Plus, you said deflationary trends of there's a lot of older people, but most of those older people can't retire. Most of the pensions don't have any money. The majority of these pensions around state pensions should be bankrupt. And that's going to cost more than COVID. The money they've spent for COVID, it might be, who knows how much more. I know there's people that actually have done that math, but then it's how do you, that's what I mean. I hate to say it because people just say, oh, you're being negative. But if you really look how on earth do you, there's so many tailwinds of hurricane force that, come out of that. So
I would say that the good news and bad news. The good news is that we do have a lot of technology, right? So technology has improved over time. So basically we have more tools to kind of deal with, even if you go through a very hard economic period, it's easier to go through it when you have better technology than if you say you're kind of repeating the 1930s. So if you're kind of have a similar debt bubble now, I'd rather go through it, for example, in 2020 than I would in 1930, for example.
That's true.
There's that. So on the other hand, one of the kind of the dark ways to look at this period is that we've, in some sense, been in a depression for about 12 years now. And what I mean by that is, if you look back at the Great Depression, so you had the 1929 bubble, then you had the big fallout from there, and we had 3 years of just brutal. The GDP went down, stock market went down, and it kind of bottomed in 1933. That's when they started doing that whole gold depegging and all that. Then you started to get kind of a rebound from there. So you had the stock market go up, you had kind of unemployment kind of find its bottom and start to improve, and you had an improvement all the way up through about 1937. And then in 1937, they had another recession. It wasn't as big as the previous one, but it was kind of they had another recession before they ever had a real boom. So they kind of, then they, in 37, 38, 39, it was just kind of a really kind of stagnant environment with slow growth. And then, of course, you had the war start in the early 40s, and that kind of changed everything. And you started to kind of just throw money at it and reindustrialize everything, and it was a really kind of challenging time. So if you fast forward after 2008, so we had that big fallout, and then we had a rebound. So we had that recovery. However, this has been one of the, even though it's been a very long recovery, it's been a very slow growth recovery. There's not been a lot of, there's not been a lot of fast GDP growth. We barely got above 3% inflation adjusted GDP growth in the best years during the past kind of decade long expansion. And if you look at labor participation rates, so unemployment rates only kind of measure people that are actively looking for jobs and can't get them. So there's kind of different ways to measure it. There's people that can't get any job, and then there's people that are kind of underemployed, or they want, say, full-time work, but they can only get part-time work, for example.
Okay.
That's kind of another measure. It's called the U6 rate. It's another unemployment measure. Then there's people that are underemployed. So they got a history degree, but they're working at Chipotle or something, and they want to have a job that kind of uses more of their skills, but they're in kind of a job that doesn't require what they've specialized in. So you have that underemployment problem. And then if you look at another measure is just labor participation. So you take the adult population, and you can even say between the ages of 18 and 65, for example, and you kind of look at that and you say, okay, what percentage of those people are working? And that never got back to its peak level. So we've had kind of a smaller share of the population working. Now, some people would guess logically that's because we have older societies, so we have fewer people working, but it's actually somewhat been the opposite. So older people, in some ways, are more likely to work than they used to, which you touched on, because many people can't afford to retire. On the other hand, we actually have younger people under 25. Especially men, the current environment's kind of displaced a lot of jobs that were more traditionally male, like manufacturing, and so we actually have kind of a spike in young male unemployment
and male suicide. This is the highest rate male suicide's been this year, because obviously so much of even more men have lost their job, and there's so much of that psychological fulfillment in life, I guess.
Yeah, so even beyond the unemployment rate, we've had kind of just reduced labor participation. So we actually peaked in that metric back around 2000, and then we declined, and then we fell after the 2008 crisis, and we never really got back to those levels at all. And it's partially just because we're aging, but even if you just account for age, it's really kind of young people, and with an emphasis on young men, and a lot of that is because of how we structure the global reserve currency. So in order to kind of have the dollar as a global reserve currency, and have kind of all commodity pricing worldwide happen in dollars, we have to run pretty big trade deficits to have that happen. So as a result, we've kind of outsourced a lot of our industrial base over the past, call it 40 years, even more so than some of our other advanced peers like Germany or Japan. We've kind of moved out a lot of those manufacturing jobs, even more so than other developed nations. And so that's kind of historically that disproportionately hurt men, for example.